Welcome to the Bulls, Bears, and the Bell podcast.
Thanks for having me back.
Yeah, of course. So today is Thursday, August 13th, 2026, and we've got a massive deep dive ahead of us.
Oh, absolutely. The post-market data flooding in right now is just, I mean, it's wild to unpack.
It really is. So our mission today is to look at this massive stack of market data and figure out what on earth is actually happening under the hood of this market.
Right, because on the surface, everything looks picture perfect.
Exactly. I mean, steering a multi-trillion-dollar economy is supposed to be, like turning a massive ocean liner. It takes miles and miles just to shift a few degrees.
A very slow, very painful process.
Yeah, but looking at the data today, the Federal Reserve isn't steering a ship. They're driving a sports car at 90 miles an hour.
Yeah, that's a good way to put it.
Right. Like, they slammed on the brakes with interest rates a while ago, and somehow they're just gliding this speeding car perfectly into this impossibly tiny parking spot.
Without a single scratch on the bumper.
Yes. The elusive macro soft landing. And, I mean, the broader market is certainly throwing a party to celebrate.
Oh, a massive party. The indices today were historic.
Truly. Let's look at the scoreboard. The S&P 500 closed at 7,798.99.
So close to that psychological level.
I know, knocking right on the door of 7,800. And that is up 0.65% for the day, which makes it the 27th record close of the year.
27. It's just staggering when you zoom out.
It is. But the central mystery we are unpacking for you today isn't just about the market going up. It is about this really bizarre, contradictory behavior we're seeing beneath the surface.
Yeah, the split market reality.
Right. We have a market that is just violently punishing some of the most prestigious artificial intelligence companies on the planet today, while simultaneously private equity is out there dropping tens of billions of dollars on traditional, boring software.
It creates a fascinating dynamic for anyone trying to navigate this landscape right now. Because, the market is euphoric on the macro surface, but underneath, it is evaluating individual businesses with absolute, unforgiving ruthlessness.
And to understand that ruthlessness, we really have to establish the foundation of today's market mood.
The macro picture.
Yeah. The stage was set before the opening bell even rang, and it was entirely driven by the July Producer Price Index.
The PPI print. And it was a shocker.
It was. It came in completely flat, 0.0%.
Wall Street was bracing for a 0.2% increase.
Right. So prices at the wholesale level essentially just stopped rising. Full stop.
And that data point doesn't exist in a vacuum either. It follows yesterday's incredibly soft consumer price index print.
Just CPI, yeah.
Exactly. So the fever has definitively broken.
But wait, I want to push back on that a little bit.
Sure.
Looking at the underlying reality of that flat PPI number,
Sure.
is this actually signaling a strong, fundamental supply chain recovery, or are we just seeing a temporary illusion caused by energy prices?
That's a fair question to ask.
Because Brent crude oil fell 1.5% today alone.
Yep.
And if oil is cheaper, obviously it costs less to ship a container of goods, which naturally pulls the overall PPI down. So is it just oil?
Well, that is a crucial distinction. The drop in Brent crude absolutely provides a massive disinflationary tailwind.
Right.
I mean, cheaper energy permeates every single level of production.
Of course.
However, it is not just an energy illusion.
Really?
No, because when you strip out those volatile sectors like food and energy to look at the core data, we are still seeing structural cooling in the prices businesses charge each other.
Oh, wow. Okay.
Yeah, the supply chains that were completely snarled a couple of years ago, they have fully normalized. Production efficiency is back.
So they're just running smoother now.
Exactly.
Right.
So for the financial markets, this combination of normalized supply chains and falling oil creates the ultimate green light.
It takes away the fear of the Fed.
Precisely. It officially removes the threat that the Federal Reserve will keep interest rates higher for longer.
And the bond market reacted to that green light instantly today.
How aggressively?
We saw the 10-year Treasury yield drop from 4.68% down to 4.64%.
Which is a huge move for bonds.
Right. So when that yield drops, borrowing just gets cheaper for these big tech companies to fund their massive server farms, right?
That is certainly a significant piece of the operational puzzle. Cheaper debt absolutely means cheaper expansion.
Yeah.
But the more profound impact of that dropping yield is actually how institutional investors calculate the value of future money.
Okay, unpack that for me.
Sure. So high-growth tech companies are valued based on the massive profits they are projected to make 5 or 10 years down the line.
Right, the whole "we'll make money eventually" model.
Exactly. But when government bond yields are high, investors can get a safe, guaranteed return right now.
Risk-free.
Right. Which makes those distant, risky tech profits look much less appealing.
So the gravity's too strong for the tech stocks to fly.
That's a great analogy. But when that 10-year yield drops, like we saw today,
The safe return isn't as attractive anymore.
exactly. Investors are forced to take on risk to find yield, and suddenly those massive future tech profits look beautiful again. The gravity weakens.
And that dynamic perfectly mapped onto the indices today.
Oh, absolutely.
The Nasdaq led the entire pack. It was up 0.81%, closing at 26,803.03.
Tech was absolutely flying.
Yeah, but then you look at the Dow Jones Industrial Average, which is, packed with older, slower growth companies.
For value stocks.
Right. It barely participated. It closed positive, but only up 0.13%, sitting at 53,839.99.
A huge divergence.
And our small caps in the Russell 2000, they just saw a very modest bump of 0.2%.
So the sector rotation reflects that weakening gravity perfectly.
The capital's just hunting for growth.
Exactly. When inflation fears dissipate, capital aggressively flows toward growth. I mean, communication services jumped 1.56% today alone. Meanwhile, the defensive sectors, the places investors hide when they are terrified of inflation.
Yeah, like real estate.
Right, they were completely abandoned today. Materials dropped 0.73%, and real estate severely underperformed.
Okay, so the public market is acting like this incredibly strict teacher right now.
Huh. How do you mean?
Well, they're handing out easy A's to the macro economy. The inflation numbers look great. But when you look at how they are grading individual tech and AI companies...
Whoa, they're grading on a brutal curve.
Exactly. Having the letters AI in your corporate title doesn't give you a free pass anymore.
Not even close. The grace period for simply, building the technology or promising the future, that is over.
It's show me the money time.
Exactly. We have entered the deployment phase, and the market is strictly demanding financial execution.
And the undisputed heavyweight champion of that execution today was Applied Materials.
Oh, what a quarter.
Ticker AMAT. They released their Q3 numbers after hours, and it was a spectacular beat and raise.
Just blown out of the water.
They reported record revenue of $9.12 billion,
Wow.
cruising past the $8.99 billion expectation. And earnings per share came in at $3.50.
Incredible numbers, but the real firework was their forward guidance.
Yeah. Their Q4 revenue guide came in at $10.25 billion.
Which is just staggering. I mean, the consensus was anticipating something much closer to $9.5 billion.
So they completely shattered expectations.
Right. And when their CEO, Gary Dickerson, explicitly cites, quote, unprecedented demand for the AI build-out, he isn't talking about language models.
All right. They don't make the software.
No, Applied Materials manufactures the highly specialized equipment that semiconductor foundries use to actually print the chips.
Ah, okay.
So if NVIDIA and AMD are selling the pickaxes for the AI gold rush...
Applied Materials is the company building the steel forge that makes those pickaxes.
Exactly. They are the base layer of the hardware reality.
And what fascinates me is how they are structurally protecting that forge.
Their supply chain moves?
Yeah. Our sources highlight that Applied Materials is aggressively rebalancing their manufacturing footprint away from China and heavily toward U.S. facilities.
Which is a vital mechanism for de-risking their future revenue.
Because of the political climate, right?
Oh, absolutely. Geopolitical tension and the threat of export controls or tariffs, it hangs over the entire semiconductor industry like a dark cloud.
So they're just bypassing it.
Right. By onshoring more of their manufacturing into the United States, Applied Materials is essentially buying insurance against geopolitical shocks.
And investors love that.
They do. They look at that strategy paired with a $10.25 billion revenue projection, and they see a company offering massive growth with an insulated supply chain.
It's the perfect combo. Another company offering that perfect blend of growth and discipline today was SanDisk, ticker SNDK.
Oh, they had a massive day.
They did. Their stock surged 13.67% following their 2026 Investor Day.
And they gave a very aggressive roadmap.
Yeah, they promised double-digit revenue growth all the way through 2030, entirely driven by the massive memory requirements of these new AI data centers.
Because AI requires an unbelievable amount of memory storage.
Right. But here's the kicker. They paired that aggressive growth with a commitment to return 100% of their excess cash to shareholders.
Which is just a phenomenal signal to the market.
It's music to Wall Street's ears.
It really is, because often, when tech companies experience a huge demand boom, they become very undisciplined.
Oh, they start buying up silly side projects.
Exactly. They waste capital on speculative bets. So by committing to return every dollar of excess cash, SanDisk is essentially telling Wall Street, we are going to capture the AI memory boom, and we are going to hand the profits directly to you.
It completely eliminates the fear of corporate bloat.
Exactly.
Okay, so that is the reward side of the equation. But let's look at what happens when a company fails this execution test.
This is where it gets brutal.
Cerebras, ticker CBRS, they have been universally praised as an absolute AI darling.
Oh, their tech is incredible.
They build these massive wafer-scale engines designed to process AI workloads faster than almost anyone else.
Yeah.
Yet today, their stock plunged 14%.
A staggering single-day loss of market capitalization?
Just a bloodbath.
Yeah.
And the catalyst for that 14% plunge, a Q2 revenue miss of just $14 million.
Just $14 million.
Right. They reported $180 million against an expectation of $194 million.
Which, in the grand scheme of things, is tiny.
It is. And the craziest part is, Cerebras is literally the engine powering OpenAI's newest GPT-5.6 Sol model.
The ultra-fast model.
Yes, the one everyone is talking about. They secured literally the most coveted partnership in the entire industry.
But the market didn't care.
Not at all. How does that happen?
Well, this requires us to look at how institutional investors price perfection.
Okay.
When a company earns the title of an AI darling, its stock price is no longer anchored to its current day-to-day reality.
It's anchored to the dream.
Right. It is anchored to a flawless, parabolic trajectory into the future. Cerebras has a brilliant architectural design, and being the hardware behind the GPT-5.6 Sol model is a phenomenal technological endorsement. But it's like a single misplayed note in an otherwise perfect symphony.
Oh, that's good.
The audience doesn't care how beautiful the rest of the composition was. They only remember the screech from the violins.
And the market absolutely heard a screech today.
Exactly. In the high-stakes hardware game, a $14 million top-line revenue miss isn't just a rounding error to Wall Street.
It's a red flag.
Right. It implies friction. It makes analysts wonder if there are, hidden supply chain bottlenecks, or if deploying these massive chips into data centers is taking longer than expected.
So the narrative is breaking down.
Narrative and partnerships simply do not beat financial execution anymore. The market is demanding proof of scale today.
Wow. So if the public market is acting like an unforgiving auditor toward the AI sector, scrutinizing every single $1 million, what happens to the companies that aren't even taking the AI test? How is the market valuing traditional non-AI software right now?
Oh, man. The answer to that provides the most compelling plot twist of the entire trading session today.
The Workday story.
Yes, ticker WDAY.
So Workday is an enterprise software company. They handle human resources, payroll, financial planning for massive global corporations.
Very essential, but very boring.
Right. It is not glamorous at all. Yet today, Workday was halted for volatility multiple times.
Unbelievable price action.
Surging anywhere from 18.8% to 25%, closing around $208 a share.
And this surge had absolutely nothing to do with earnings or an artificial intelligence pivot.
Nothing. It was entirely driven by reports that the private equity giant Silver Lake is at advanced talks to take Workday private in a massive leveraged buyout.
And the valuation being floated is $43 billion.
$43 billion. That is an astronomical sum for HR software.
It really is.
But if you connect this back to what we discussed in the first segment regarding the 10-year yield dropping, that provides the exact mechanism making this deal possible, doesn't it?
Absolutely it does. Leveraged buyouts of this magnitude are financed primarily with debt.
Hence, the leveraged part.
Right. When interest rates were peaking recently, borrowing $20 or $30 billion to buy a company would result in interest payments so high they would literally bankrupt the target company.
The math just wouldn't work.
Right. But with the 10-year yield dropping and the macro environment signaling a soft landing with rate cuts on the horizon...
Debt is cheap again.
Exactly. The math on massive private equity buyouts suddenly works again.
Okay, but out of all the companies in the market, why is Silver Lake dropping $43 billion on Workday?
Because of the cash flow.
I mean, the public market is completely obsessed with AI chips and language models, yet the smartest private money in the room is buying payroll systems.
Well, private equity operates on a completely different set of incentives than, say, a retail day trader. The public market wants hypergrowth and the shiny new paradigm. Private equity wants predictable, ironclad cash flow.
They want a sure thing.
Exactly. They look at a company like Workday and they see the ultimate sticky business model.
Sticky meaning the switching costs are just too painful.
Yes.
Like if you are a Fortune 500 company with 30,000 employees and your entire payroll, your benefits administration, your financial forecasting, if all of that is deeply integrated into Workday's architecture,
You can't just unplug it.
right, the friction required to migrate that data to a competitor would take years and cost millions in lost productivity.
Precisely. Once you are in their ecosystem, you rarely leave. So from Silver Lake's perspective, they aren't buying boring software.
What are they buying?
They are buying an entrenched enterprise utility. It generates highly predictable recurring revenue month after month, year after year.
And by offering a $43 billion premium, Silver Lake is essentially broadcasting to the world that public traders are entirely wrong about how they value traditional software as a service.
Oh, completely wrong.
The public market is so blinded by the glare of the AI revolution that they have left these incredibly lucrative, essential sauce companies trading at a massive discount.
It's a massive arbitrage opportunity.
Right.
Private equity recognizes that even as AI transforms the world, global corporations still need software to run their basic day-to-day operations.
Someone still has to cut the checks.
Exactly. And whoever owns the data layer of those daily operations holds immense power.
That makes total sense.
Mhm.
And the after-hours action today really reinforces how hyper-focused the market is on specific fundamental catalysts rather than just general hype.
Definitely. Look at Capricorn Therapeutics.
Yes, ticker CAPR. They reported their Q2 results today.
And the standout number wasn't a revenue explosion.
Not at all. It was their balance sheet. They're sitting on $238 million in cash while they wait for the FDA to review their drug, Duramyocel.
Which, in the biotechnology sector, holding $250 million in cash during an FDA review is a massive strategic advantage.
Because biotech burn rates are insane.
Oh, notoriously high. They spend millions every single month on trials and operations without generating a dime in sales.
So if they don't have that cash cushion, they are forced into a terrible position.
Exactly. They're forced to raise capital while waiting for the FDA's decision.
Which means selling stock.
Right. Raising money in that window usually requires issuing new stock at a steep discount, which severely dilutes the value for existing shareholders.
So by securing $238 million in cash now, Capricorn completely removes that dilution risk.
Exactly. They can confidently fund their operations through the regulatory review. Then if the FDA grants approval, they can immediately fund a commercial launch.
Without having to go beg the market for cash at a disadvantage.
Exactly. It's a position of strength.
It all comes back to risk mitigation and execution, whether you are building semiconductor foundries or waiting on the FDA.
The rules apply everywhere right now.
Right. And just rounding out the post-market movers, we saw Enhanced Group release Q2 results that sent their shares jumping 14.4% early in the extended session.
Because capital is actively hunting for fundamental performance across every single sector.
So we are witnessing a real maturation of the market.
I would say so. The liquidity is abundant and the macroeconomic headwinds are fading.
Yeah.
But the criteria for success have permanently shifted from promises to profits.
Well said. So as we synthesize this massive stack of research for you to take away today, the through line is incredibly clear.
The macroeconomy has pulled off the soft landing.
It really has. Wholesale inflation is flat at 0%, Treasury yields are dropping, and the broader tech index is breathing a massive sigh of relief.
Yet beneath that rising tide, the crosscurrents are treacherous.
Exactly. If you are a company operating in 2026, you cannot simply draft off the macro tailwinds anymore.
No, you have to prove it.
If you are an Applied Materials or a SanDisk, proving your revenue pipeline, managing your supply chain effectively, and returning cash to shareholders.
You will be heavily rewarded.
But if you are a Cerebras possessing the greatest technology in the world and powering OpenAI, A fractional miss on revenue will still result in a brutal punishment.
The market's tolerance for error is practically zero right now.
And while the public markets remain fixated on the volatility of those hardware and AI narratives,
Private equity is exploiting the distraction.
yes, they are quietly swooping in with billions in newly cheap debt to take over the boring, sticky software companies the public market has just left behind.
It really is a fascinating dynamic.
Which brings us all the way back to the sports car analogy from the beginning.
Right.
From a distance, the Federal Reserve parked the car flawlessly, 7,798 on the S&P.
A perfect landing.
But under the hood, the AI hardware pistons are firing with unforgiving volatility, while the traditional software engine is being quietly dismantled and bought up by private equity.
It really forces a total reevaluation of where the actual value lies in the technology sector today.
It absolutely does. And I want to leave you with a final thought to explore on your own as you digest these moves today.
What's that?
We are completely captivated by the foundational AI build-out right now. The data centers, the chips, the models.
All anyone talks about.
Right. But as that infrastructure scales, how many other entrenched, essential software companies are currently sitting at a severe discount?
That's a great question.
How many of them are quietly waiting for a massive AI integration to revitalize their platform, or for a private equity whale like Silver Lake to buy them out entirely? Will the next great wealth generation in tech be defined not by who builds the smartest AI, but by who aggressively buys up the companies that actually use it?
Something to really keep an eye on.
Think about that next time you look at the ticker tape. Thank you so much for joining us on this deep dive into the August 13th market data, and we ask that you please subscribe on Spotify or your favorite podcast app. We'll catch you on the next one.